Welcome. Good evening. We're going to give a minute or so so we can give people a chance to join. Good evening. I hope everyone can hear me okay. All right. Good evening. Welcome to the Arabella Capital Multifamily How to Succeed in Multifamily Real Estate webinar. This is a recorded webinar. We also, when we record these webinars, we do them live just so that we can have some interaction if there's any questions. That helps the video. And my name is Adam Whitmire. I'm going to go through a little bit of disclaimers here first. This is not a solicitation or an offer to purchase securities. We're going to talk about strategies a little bit tonight as well when we talk about multifamily. Some of these strategies may or may not be appropriate for you. You always want to counsel or consult with your advisors. Past performance is no guarantee of future results.
Do we have any way of knowing? Oh, we've got 4 participants. Who's on?
Hey, Rob, I think we can hear you. And we're live, by the way, so you're welcome to jump in.
Sorry, keep going.
That's okay. So let me go back. So my name's Adam Whitmire, and I'm one of the principals in Arabella Capital. I've been in real estate investing and development for, I guess, about 3 generations. My first experience with multifamily was I was about 7 years old, and my grandfather hired me to pick up copper wire as we were building some apartments. I would pick up the copper and we would recycle it and help him just kind of clean up scraps around some of the apartment buildings. So that was my first introduction to multifamily. It's been a very interesting trip since then. So most of my background over the last 20 years or so has been in land development, home building, single family, multifamily, new construction, and also portfolios and fund management. Lots of fun working in a fund. And I've got a lot of different, a lot of education, a lot of formal and informal education in the business. Also, I've got Rob with me as co-founder of Arabella Capital as well. Rob's been in the as a real estate investor over 10 years in the business, investing from out west. He's in the West Coast. I'm on the East Coast, and he's developed and owned and operated, I guess, hundreds of single family rentals, renovated some multifamily, a lot of experience in the space. So we're going to dive right into it. This is meant to be a high-level introduction for those that are looking to either enter into the multifamily business, get more information about the multifamily business, and just kind of get a broad overview. So the first thing I think is important to share is that the National Apartment Association recently reported that the United States needs about 4.6 million multifamily units by 2030 to keep up with demand. That's about 328,000 new units annually over the next 10 years. Now, where did they get that number? Where does that come from? So if you think about it, right now, they take the number of households, the number of available apartment units that we have on the ground in the United States that are available for lease, and they take the number of people, the demographic that currently leases those. And if you look at household formation, which means there are more new people moving out of their parents' homes, people moving into the areas, moving into the country, and you add those new renters, and we are behind. So we have a very high demand. We also have a high demand for single family, for renting and home buying and apartments. So housing is a really interesting topic right now in the US. And we're going to talk about some of the main components that you need to think about and consider when investing in multifamily. And Rob, again, is before I go dive into this deeply, if there's anything else that you wanted to touch on about some of your experience or our experience, or you're welcome to jump in at any point. So step one, or at least is basically going to be considering your team. And step two is going to be your location. Step three, buying right. And step four, we're going to get into asset management. And I want you to consider the team, because real estate is not a passive investment. Real estate is an active investment. What that means is that you're not just going to invest money into something and it's going to magically start producing cash flow. Apartment investing in particular requires a very good team. So you want to make sure that either, if you don't know how to operate or run an apartment building, how to manage one or manage a property management company really well, you need to find someone that does. So let's jump into it. Having the right team. So building a real estate team, it's not a one-time thing. Again, you're going to oftentimes go through and work with people that you realize that it doesn't work out, and people that you realize it does work out. So being successful at managing really is trying to figure out what's working, who's working, and where they work the best. What you're trying to do is create efficiency. And you're going to look at your business, or you're going to look at apartment building or whatever it is, and can you create efficiency? Or is there someone that you've got on your team, or if you got a partner that you're working with that you can create efficiency with? And as you network and talk with people, you're going to see what kind of personalities that you work best with. You ultimately, at the end of the day, no one's perfect, but you need someone that can perform and someone that you can rely on. You want to get people on your team that you don't have to babysit. A lot of times people look for the person that's the least expensive. And ultimately that's not your main objective. It's not about necessarily the least expensive partner, least expensive contractors. It's the ones that are going to get the job done so that you have less headaches and you can sleep well at night. So I'd say I've got a number of partners. This is real estate. We partner with a lot of people in real estate. So I would say about 5 years ago, about around 2015, maybe 2014, actually in 2014, I was introduced to my current partner who we, it's a multifamily partner that we operate deals together with. And he actually does the property management for us. And I met Joe about 6 years ago. And he's in his 70s. He's been operating and owning and managing apartments for the last 50 years. He got bored of it and wanted to do something a little bit different. So he partnered up with me and we started working on subdivision and home building, because that was my background. And I also had some background in multifamily, but at the time, from 2010 up until that point, I'd been solely focusing on single family rentals, because that at the time, that's where we felt like, and Rob and our team really saw the value at that time in the market. They were very undervalued, tremendous opportunities to pick up single family homes and single family rentals. So we did that. Fast forward a few years, and Joe has, he's done a fantastic job with his portfolios, doing a fantastic job with our portfolio. But ultimately, I had to spend some time there to figure out, first of all, am I compatible with this person? Does this person do a good job? So when you're looking at where you want to invest and who you want to invest with, this is the most important thing, is do you have the right team? This is going to make or break the deal. Okay. The second thing is going to be location. Let's talk about, where do you want to invest in? A lot of people want to invest locally near where they live, near the house. That may not be the best place to invest. If you need to be there to help oversee it, maybe you have to invest locally. But ultimately, apartment investing is something you can do at scale. It's something you can do anywhere in the country. You don't have to live there. You just have to find the right people. So let's talk about location. There's a couple of different kinds of cash flow. Okay. There's cash flow in markets that just primarily spin off, high amounts of cash flow. Like, for example, if we're investing maybe in the Midwest, we're investing in areas that don't have a lot of inward migration. They don't have a lot of growth. in those areas, we see a lot of cash flow, whether it be single family or multifamily. You're going to underwrite a deal, and the amount of cash flow that you can buy for the amount of money that you're investing is often real high. So on paper, a lot of times these deals look like they have high cash flow. Ultimately, to make money in real estate investing, you have got to go in and be able to create growth opportunities. You have to increase your NOI. NOI is net operating income. And to make money in apartment investing, you have to be able to either reduce your expenses or increase your income. Okay. There's several ways to do that. We're going to talk about a number of the different options, but ultimately if we see a good opportunity to invest to get into an apartment deal, we're going to look in areas where we feel like that there's going to be income growth. We feel like there's going to be population growth, and we're going to invest in areas where we understand the market. If you're investing somewhere blindly and you don't understand the market, it's going to be a little bit more like gambling. But ultimately, why do we want to invest in areas that have higher population growth or higher job growth or even income growth? Because like I said before, to make money in apartment investing, you've got to either reduce the expenses or increase the income, or a combination of both of those. Apartments are valued based upon the income that's coming in. So it's an income valuation. And they're often traded on something called a cap rate. And the cap rate is calculated by taking your net operating income and dividing it into your all-in cost. So basically whatever you paid for, that's going to give you a percentage, making that a percent, and that's your cap rate. And that's what apartments and income properties typically trade on, a cap rate. So ultimately, if you're in an area that has population growth, and typically it has population growth because there's job growth, or it's an area people want to move into. And often in those areas, the supply and demand works in your favor. And those areas typically have income growth. And so with that income growth, you can increase rents. If you're in a market where it's pretty stable and incomes aren't increasing very much, then it's going to be difficult for you to raise rents a whole lot, right? Ultimately, you're going to hit a limit to where the tenants that are renting from you are capped out. They're not going to be able to pay more. And you're done. That's it. So basically, you're going to have, in those markets, you often have good cash flow, and that cash flow will be stable for a long while, but it's not going to grow a whole lot. And in apartment investing, it's not just about the cash flow you're getting right now. It's about the value you're creating. So we do something what we call value add investing. And value add investing is where you go in and you renovate and you try to increase rents. And because ultimately, let's say if you're buying an apartment complex and it's worth $5 million, if you can go and increase rents and reduce expenses and increase the amount of cash flow, that cash flow, all of a sudden that changes the cap rate. Now all of a sudden your cap rate changes. And the more income you get, it increases the value of the property. So for example, $25 a month, and that times 12, that's $300 a year. That $300 a year divided into whatever cap rate is going to give you a dollar value. And when you're increasing it just 50, 25, 150, or a couple $100 a month, depending on the size of it, that'll give you hundreds of thousands, in some cases, millions of dollars in value on an apartment complex. Okay. So finding the right location, for us, we're looking for areas that are not just stable cash flow. We look for areas that have growth. We look for areas that have population growth, job growth. People are moving into the areas. Okay. That gives us the best chance of increasing those rents over time. So for example, we've got, and one of the main deals I'm going to talk about tonight is one that we have under contract. We're going to be closing this deal soon. It is in Charleston, South Carolina, support area. We're focused in the Southeast. We like the Southeastern United States because of the population growth, the affordability. A lot of people are moving in. There are other areas in the United States that also have high inward migration, a lot of people moving in, a lot of job growth, a lot of income growth. Okay. But at the same time, in those areas, you're also going to have competition. So sourcing becomes a factor. So let's talk about some of these components. Step number one, sourcing. Where are you getting your deals? right? Do I get it off market? Do I get it from brokers? This all depends on the size of the apartment complex that you're working on, or the size of the investment that you're looking at. And ultimately, most of the deals that we purchase are from 200 to 400 units, which means we compete in the space with institutional buyers. And sourcing is important in that space. Most of your sourcing, most of your sophisticated sellers are going to take a property to market. And what that means is they're going to hire a broker. A broker is going to send it out, and they're going to have what's called a call for offers. Most of your sophisticated sellers are going to do that because they want to put it out there and get the highest price possible. If you want to stay under the radar, not compete with institutionals, then you stay under that 150 unit mark and get into mid-size and smaller multifamily deals, and you can often not compete with them. So what's happening when you do that is you have a chance to get higher returns. The dollars are less. The dollars that you're going to bring in on an annual basis are less, but at the same time, the cost is less. And that's one thing we're going to have to talk about is, where are you getting the money to invest? How are you investing? Number two, the second component is financial underwriting. Can I underwrite this deal financially? Is there someone on my team that can underwrite it? We're going to do some webinars later down the road where we're going to go through an underwriting and show you how to underwrite a deal. But ultimately with sourcing, again, if it's a larger complex, it's probably going to go to market. And there's some benefits to that. There's also some drawbacks to that. The third component is understanding of the management team. This is not your management team. These are not your partners that you're working with. This is the management team on site. Because when you find a deal, if it's a larger complex, they're probably going to have on-site management. If it's a small deal, you're not necessarily going to have on-site management. Often, if you're 50 units or under 50 units, you're not going to have on-site management. If you're closer to 100, 150 or more, you will likely have on-site management. And the reason being is because you're going to be leasing those units on a regular basis. Ultimately, if you have 150 units and the average tenant stays 12 months, that means you're going to be leasing up 150 units every year, basically. So you got to think about that's going to require an on-site leasing staff. And the larger the apartments as well, it's going to take into consideration that you're going to need some on-site maintenance person, maybe a maintenance staff. In an apartment complex where we've got 200 to 400 units, we often have multiple employees. We've got a manager, and a leasing agent, and maybe a couple of leasing agents or an assistant manager. And we've also got maintenance staff. We've got a maintenance person and an assistant to that maintenance person. So we're going to typically have about 5 employees on an apartment complex that size. You may not have that many. Again, the smaller it is, the less you're going to have. It's all about controlling cost. In the apartment world, it's all about controlling cost. So you need to understand the management team. Now, with the larger apartments like we have, we're going to go in, and that team, ultimately, we're going to go in and we're going to visit them and see how they operate. We'll take a look at all the leases. We may go check out some complexes nearby and see how they're doing or what they think about this complex. And your management team is going to make it or break it. Those are going to be people that are on the ground. You got to make sure you've got the right number and they're being paid properly, and you got to make sure they're going to do a good job. So what's going to happen typically when you buy the apartment complex, the employees there will often stay with the new owner. And so you're taking that complex, but you're also adding that on-site management team to your current staff, to your current team. So those are things to consider. So you're not just looking at the deal, you're looking at the management team, who you're going to have in place, who's going to be there. Financial underwriting, like we talked about, and sourcing, those are all very important. But the fourth component is financing the acquisition and construction. Okay, how are you going to get financing? Most of your larger apartment complexes use what's called agency financing, Fannie and Freddie, very inexpensive financing, and is a very long underwriting process. So financing the acquisition is important. So we get questions oftentimes from some of our investors on, okay, so how do you invest if you don't have a lot of money? If you don't have a lot of money, you're going to have to partner with somebody that does have money. There are three important factors in putting an apartment deal together. You've got to have someone that knows how to operate an apartment, or property management team that's skilled. Oftentimes they call us asset managers. So we do our property management in-house, but it's, like I said, it's through a partner. I've got a partner who's been doing it for 50 years. So I would be what's called an asset manager. I help him make sure things are going well. I make sure the asset goes well. And so you need someone that can operate it. You need some investment capital. You're going to need some capital going in, and either you're going to invest, or you're going to invest with a few people, or you're going to have to partner with somebody that does. And those are really important. The third component is especially if this is more important if it's a larger complex, is you're going to need someone that has enough experience in multifamily that can sign off on a note, that can sign off on a loan for multifamily. Surprisingly and interestingly enough, there are actually groups and people out there that's what they do. They will charge you 5% of the GP, and they will sign their name because it's typically a non-recourse note. And they'll sign their name because they've owned a number of apartments, and you give them a little bit of the GP. They'll sign on the loan, and you're in business. So now what you've done is you found someone to help you secure the loan. You found an operating partner, that can do the property management and help you operate the complex. And then you've found someone that has some capital like to invest. So ultimately, you technically don't have to be any of these people. You can put this team together, or you're going to be one of these other three people. But these are the three main factors, or the three main roles that go into closing on an apartment complex. Now, let's say you've managed to find the right location. You found a location that you feel like is, the wind's at your back, and the wind's, blowing your sail. You've got income growth, population growth. Everything looks good. You found a complex that you feel like you can add some efficiency, meaning a couple of different things. You feel like that you can manage it, or your team can do a better job at managing it than they're doing. Or you found a complex that just needs to be renovated, needs to be updated. The great thing about real estate, and nowhere better can you see this in apartments, is that they get old. Apartments just get older. That's what they do. So what happens is someone comes in, renovates, hold the apartment complex, and getting close to about 10 years later, maybe 7, 8 years, they start, upgrading some of the units. So in 8 and 10 years later, they're upgrading some of the units because they're getting old, they're getting dated. So they put a little money in it. They'll upgrade the units. And when they upgrade it and put a new tenant in, they raise the rent. So they'll bump the rents maybe, $150, $200. And they'll do that for maybe a fraction, maybe a third of the complex. And then they'll say, hey, it's time to sell. Let's put it on the market. We've increased the value of this complex. It's worth more than what we paid for it because we've increased the net operating income over time. And so they'll renovate and do some big rent bumps on a portion of the complex to show a value add. And then they'll take it to market and say, hey, here's what we did. Here's our proof of concept. We were able to increase the rents on the third of these. You can come in here, finish the renovation we started, because this complex is old. It's 10 years old and it needs to be updated. All these units need to be updated. And then you can benefit from picking up that equity after going in there and renovating. And that's what they do. And that's what we do. And ultimately that's our strategy. And, it's a fantastic strategy because I love buying something for a lower price, adding some value to it, and all of a sudden it's worth a lot more than you paid for it. There's nothing greater than selling something and making a few $100,000 or a few $1 million on a project is just fantastic. So milestones. Once you've been able to put your team together, you've been able to find a deal, find the right market, close on a deal. Now you've got to make sure that you can hit your milestones. The first one's typically in most situations, but especially in a value add situation, is you're going to have some construction deadlines and some construction timelines, because you're going to go in here and you're going to have typically some renovation to do. It may mean that you're going to do some renovation on the exterior to look at nicer, landscaping. I'll tell you, the older the complex, the more money you have to put into landscaping to make it look newer, nicer, well kept up. Also the entrance. So the entrance, you want to decorate it, make it look really nice, really inviting, make people want to live there. And in some cases, if you know that an apartment complex just has a bad rap, or it's just, it's just not appealing for certain people, then you should maybe rebrand. There are times when you need to rebrand that complex, change the name, give it a new look, just create some new excitement around it. Now, the biggest value add, though, is typically within the units themselves. And you're going to do this as tenants' leases are up. As they move out, you're going to go in, you're going to renovate a unit, increase the price, put it back on the market, lease it up again. And you're going to do that every time somebody moves out. You're going to lease it up. The things that we've been most successful with are adding washer and dryer hookups, LED lighting, adding dishwashers, making sure they have proper, heating and air. But the biggest one I would say would be washer and dryer hookups. You would be surprised how many apartment buildings do not have washer and dryer hookups, or they're operating on they've got a little laundromat out on site somewhere, a laundry room where people are paying money to get their laundry done and carrying it out there. Nobody likes doing that. Everybody would just rather have it inside. So when you're touring a complex and you see maybe there's a space or an area there where you can add a washer and dryer hookup, or there's some space you can add a little small dishwasher, things like that really make a big difference. Upgrading the cabinets, the countertops, redoing some of that, updating the flooring, making it a little bit more modern is going to make it more inviting. People will actually, pay more for those things. But again, the washer and dryer hookups are a big one. And that's the one that we definitely do really well on. So what's going to happen is, let's say for this particular one, we've got 350 units in this complex. It's going to take us probably 18 months, close to 2 years to renovate, to turn over those units, renovate them, get them back on the market at the higher rent. So it's probably going to take us a couple of years almost to do our value add. So what happens after that, right? What happens after we've renovated it and we've leased it back up, and now we have a higher rent? So what we've, in essence, what we've done in a short amount of time, we've substantially increased our net operating income. And now the complex may be worth, $6-8 million more than what we paid for it. So at that point, we've got some options. We've increased the NOI pretty substantially. We've done our value add. Now it's worth something. We can either continue to hold it. And now to buy this also, we had to partner with some people that was able to contribute some equity, or we have an equity partner in this. And so maybe we want to get some of that equity back out, give the money back to our partner, or move it over, or take that money, move it over to another deal. So at that point, we'll typically want to refinance, put on some new, very inexpensive agency debt, and pull some of that equity out now because it's worth a lot more than it was before. And then we can give that equity back, or we can move it into the next deal. What a beautiful thing. Leverage is fantastic. I love living in America. I love it that we can get leverage and inexpensive debt. Now, after that, we'll typically want to sell it. We'll either sell it after they do the value add. And for us, we look at 3 to 5 year holds. You can focus your hold time as long as you want. You can hold it 7, 10 years. You can hold it, forever if you want to. But ultimately, equity, sometimes if you're raising equity, it's not yours, it gets expensive. So you want to give some of that equity back. And the sooner you give that equity back, the more profit you're going to end up with, because it's costing you less now. So oftentimes after we do the new value add, we'll refinance it. And then we have some decisions. Do we keep it? Do we sell it? We don't want to sell it too early. When should we sell? How long should we hold it for? And ultimately, those are great decisions. I'm going to show you some deals that we did last year that Joe's team really kind of put together, and from a timing standpoint, did really well and benefited fantastically. Just to give you a little bit of information, a little bit about our team. Our target, we typically target for these larger 200 to 400 units, a 15 to 18% IRR. So we're really targeting trying to get to the higher end of that, around 18%. We're trying to hit an equity multiple of 2%. Now, an equity multiple basically means is if you take the amount of equity the amount of down payment that you had to put in the deal, and you take the net profit you received after you got your equity back when you sold it, this basically means you doubled your money. So in 5 years or 7 or 10 years, if you can double your money, that's a fantastic deal. If you can double your money in a 5-year time frame. The IRR, this stands for internal rate of return. What that means is if you take all the cash flows you made while you're holding it, and then you take the money you made at the end when you sold, you're going to receive, the total, your annualized return over that whole 5 years was around 18%. And we've done over 2,800 units, I guess, in the last 5 years. It's a couple $100 million in value. And our strategy is basically, it's all about performing, right? We're looking for something that's underperforming the market. If we can find a complex that, the rents are below market rent, what a market rent should be for that complex, we know it's underperforming. We know there's some room. Maybe we need to get in there and find out what's going on. Their rents are lower than everybody's. We should be able to get in there and improve that complex, bring the rents back up to market. That's the primary thing that we look for. We have in-house management. Sometimes it's challenging when you're outsourcing management and they focus on their fees more than they do your returns and your cash flows. You have to be very careful about that. And sometimes when you're outsourcing, they're just going to they'll renovate things, or they'll do things, or they'll spend money that you normally wouldn't spend if it was yours. So again, you really have to focus on that. And we've got a fantastic team. I'm not going to go very deep into this. Some of our track record kind of stands for itself. This is what I really want to show you. We had 3 deals that we sold last year. The lowest rate of return, I don't even think they're all in here, but the lowest rate of return we had on one of those deals was a 52 IRR. Most of our deals, again, we're targeting 18%, but I'm telling you, you guys don't know how the market's going to perform. In other words, if buying at the right time and selling at the right time is very important. You could end up buying a deal that you're thinking, okay, we're going to end up getting a 15 to 20% return on this deal when all said and done. And you could end up riding a wave. You could end up selling at a time when the market's really high, and you could end up with a 20, 30, 40, 50, like we did on 3 deals that we sold last year, internal rate of return. So it's all about timing on that sale. You've got to do it at the right time, and it's got to be in your favor. Okay. So again, this is some of the deals we've done, some of our track record. A lot of our investors, we do have a fund. We are raising capital, and it's a $10 million fund that we're raising. A lot of our investors have had been very happy with a lot of the returns that we've gotten with them. This particular fund, if you guys are interested, it's a $100,000 minimum. It's a 5-year fund. We're focusing on multifamily and build to rent projects. It is accredited investors only. That means you either have to have $1 million net worth or $200,000 in annual income in order to invest in this particular fund. If you have questions, you want to get some more information, or if there's just something that we didn't answer tonight and that you want to see us do on future webinars, you can scan this with your phone and it'll schedule a link with either Rob or myself, and we'd be glad to talk with you and get some more information. Also, if you have any questions, there is a chat box at the bottom where you can ask questions, and we'd be glad to answer any questions that you might have. But let's,
Adam, they may not know how to scan this. So basically you just open your camera and point it at this and it scans it.
That's right.
It's a QR code. Some people may not know how to do that, but just literally you can open your camera phone, scan it, and it'll pop up. You don't have to press a button. You don't have to take a picture. Nope. You just point your camera at that.
Point your camera at the screen and a link will pop up, and you just click that link, and you can schedule a call with me or Rob, and we'll be glad to answer some questions or give you some more information or detail. And again, if you have any questions tonight, there's a chat box, just put them in the Q&A and we'll be glad to answer some of those questions. Thank you, Josh. Now, as I'm closing this out and wrapping this up, let's just at least touch on the market where we're at today, right? are in this interesting pandemic. The market's changed a good bit. It's created some buying opportunities, right? There are some apartment buildings. Some of them have struggled a little bit during the pandemic. Some of them are, and when I say a little bit, in most areas, it's just been a little bit, collections, maybe 10%, maybe a 10% drop in collections. There are certain markets that are not as landlord friendly, certain states that have been a lot more difficult. And we've heard of, collections dropping, 25% are pretty substantial. And right now it's really hard to tell what the future is going to hold. We have an election coming up. We have, a lot of tenants that really, maybe some of them, you can't evict them for not paying because of some of the restrictions that due to COVID. So there's going to be some opportunity. There's some opportunities, buying opportunities for sure. There's going to be some buying opportunities next year as well. Apartment buildings will always get older. And as they get older, that creates opportunities for you to make money in apartment buying. And there's always going to be bad managers out there. When there's bad managers out there, that creates opportunities for apartment buying as well. So keep these things take these things into consideration. At the end of the day, you know what it is, right? What are the three things that we talked about that you need? You got to have some equity. You got to have someone can sign off on the loan, and you got to have someone that can operate an apartment complex. That's not something you want to jump in and do blindly. And I know, Robert Kiyosaki loved to talk about in a lot of his books about the monopoly game. So there's a lot of investors out there that started real estate investing buying single family rental homes. They build up some equity, and then one day they take that equity in 1031, exchange it into a big red hotel, which really is an apartment building, right? So they upscale to an apartment building. And so there are more zeros. It is a greater opportunity to make money, but at the same time, it's a greater opportunity to lose money. So just make sure you know what you're doing. Don't rush into it. Don't go into it blindly. Make sure you've kind of got the right team behind you. If we don't have any questions now, we appreciate the time that you spent with us. And those of you watching these videos, we hope that you enjoyed the videos. We're going to have a lot more videos coming out in the future where we break up the process a little bit. Maybe we get on site, tour some properties, maybe we dive into some market analysis, or we'll dive into some financial underwriting. But we hope this was helpful. We hope you enjoyed the webinar, and we look forward to our future conversations together. Thank you.